8, 7, 6.
Good morning, good afternoon, or good evening, everyone. My name is Antonio Candia, Principal of Financial Innovation at FLAR, and I have the honor to welcome you to our second episode of Season 2 of our Cartagena Talks. Only 2 years have passed since we published our first approximation to the topic in a paper entitled New and Evolving Financial Technologies with the collaboration of Professor Eswar Prasad from Cornell University. Since then, the rapid rise of cryptocurrencies has elicited an exponential interest in the response from central banks and governments. We are in very good company to discuss the latest thinking on that response, central bank digital currencies, or CBDCs, and the possible roadmap for Latin America. Our guest moderator is Miguel Musa, the leader of the Technology Observatory and Tech Lab of the Central Bank of Chile, which are initiatives that seeks to accelerate the understanding and adoption of disruptive technologies within the bank. Miguel, many thanks for accepting our invitation. Our virtual stage is all yours.
Thank you, Antonio. First of all, I wanted to thank FLAR for the invitation. It's a privilege to be participating in this event. For some time, honored to moderate this conversation about CBDC with the two experts, John Keefe and Chi Lo. John is passionate about fintech and especially digital assets, former senior financial sector expert at the International Monetary Fund. Prior to joining the fund, John worked at the Bank of Canada, where he was involved in various financial market analytics and trading activities. On the other hand, Chi is the senior economist for Greater China of BNP Paribas Investment based in Hong Kong. Chi has many years of international research experience in economics, financial markets, and public policy and standard development, covering Asia and North American economies. He's the author of 8 books in China and Asian economic development and markets. Both of them will be presenting their views on the topic. John will start with a general view, and then Chi will talk a little bit more in detail about China's CBDC. So without further ado, John, the floor is yours.
Thanks, Miguel. Let me just set up the screen sharing here. Okay, well, thanks for this opportunity to share my views on the growing world of central bank digital currency. As Miguel said, I'm a ex-IMF. I retired almost exactly a month ago. So you'll hear me sometimes. Sometimes I'll be talking as though I'm still the IMF. I'm still not totally detached. So you'll see me slipping from past to current tense quite a bit. And in fact, a lot of the work, well, all the work that I've done on CBDC was launched while at the International Monetary Fund. And these 2 papers that I show on the left-hand side are sort of our 2 major works on the topic, the Cast and Light paper being one that looks at the very high level considerations for issuing central bank digital currency. And the one below is a more recent one where we get into the nuts and bolts, the nitty gritties of central bank digital currency. I always kind of like to start with this slide to basically make sure we're all on the same page. There's kind of 3 different versions of the central bank digital currency. There's a retail CBDC, which is what we're focusing on today. That's one meant for general purpose use. There's also a wholesale CBDC that's meant more for managing payment systems. It's a limited use type of digital currency. And then there's a synthetic CBDC, which I'm not going to talk about today because I had to do that. I have to give you a background on stable coins, which are we just don't have time for that today. So in terms of definition, retail CBDC is a representation of a sovereign currency. So if it's a digital dollar, let's say, it would have to be a digital version of a US dollar and so on. This is important because there are some countries, for instance, the Marshall Islands, that are planning to offer a digital currency that's not based on the currency that's in common use in the country, so they wouldn't be considered a central bank digital currency. And it's backed and issued by the central bank or monetary authority. That's important too, and you can see that's what differentiates it from a synthetic central bank digital currency. And it has to be a liability of the central bank or monetary authority, so you would expect it to show up on the central bank's balance sheet. And then the other sort of necessary condition is accessible to the general public. So you can see the gray zone is kind of what I consider the core definition of a CBDC. Personally, I think you might also include the condition that it's useful for peer-to-peer transactions, so it operates like cash, that two individuals can transfer money. So as opposed to, say, a debit card like currency, which has to be channeled through a merchant or some kind of financial institution. And then the last one also, which is, I'm kind of on the fence in on this part of the definition, it should be, or it could be considered legal tender in the country, which basically means that there's a law that says that that currency can be used to pay for things, to pay down debts and obligations and so on. There's been a paper written by my ex-colleagues at the IMF who work in the legal department that fleshed this idea out. And I used to have it in the gray zone before, but for various reasons, calling legal tender a necessary condition to be a CBDC has some challenges in their opinion of these my colleagues. So this is my master work. This is something I keep up to date on my personal website on a continuous basis. This is basically my map of all the countries and jurisdictions that are contemplating or even have issued central bank digital currency. When I started this table, it was in that first paper on the first page. That was back in 2018. I think I had about 10 countries on here. Now I've got, I think it's 55 now. And I've divided the table up into various parts. The first part at the top is where the central banks have launched or piloted central bank digital currency. So the Bahamas, for instance, has already launched their sand dollar, and China is currently undergoing a pilot test of their central bank digital currency, as is the Eastern Caribbean Central Bank, and Jamaica will be launching in May, and Ecuador and Uruguay have already completed pilots. The next tier down would be central banks that are done or are doing proof of concepts. And the difference between a pilot and proof of concept is a pilot is something that the test is actually conducted with real people, real merchants. It's almost live, whereas a proof of concept is typically a more limited test of the technology and so on. In the case of the Ukraine, for instance, they did their proof of concept and they involved central bank staff, and they partnered with a couple of merchants to test it out, that it wasn't sort of released to the general public. And then there's 5 central banks that I view as being in the very advanced stages of research and development. Canada, the Euro area, and US particularly have, and well, actually all these 5 have very, very active programs. Russia will soon be doing, I think, a proof of concept, so I'll be shifting them up to the second tier. But the way I measure that advancedness is that all these countries are publishing a lot of papers. They see a lot of press releases, and there's a lot of just buzz that's coming out of the central bank on the topic. The next one, the bigger group, are the countries where they're still exploring. They're doing some research, maybe partnering with a few consultancy firms and so on to sort of see if they should issue CBDC, and then if so, what, scoping out the design features and so on. And the difference between that big group and the one below is that everything above everything 1, 2, 3, 4, the first 4 chunks, all those. If you go to my webpage and you click on one of those countries, you'll go to a link at the central bank. The ones below are ones where I'm getting the information from what I view as reputable sources. So that's I'm pretty certain that these countries in that bottom group are exploring, but I just don't have an official link. But one thing you'll notice here is I highlighted all of the central banks in sort of the Americas, except I didn't highlight Canada and the US. But so, yes, you can see here, there's quite a bit of activity in Latin America and also in the Caribbean. So it's anybody who thinks that maybe Latin America is lagging. I think it's actually a pretty active area, and it's particularly active in that top group where real work is being done on CBDC. So in my travels around the CBDC world, I mean, I sort of this table that summarizes the major motivations for issuing CBDC, and I've highlighted the ones that I found to be most relevant amongst the central banks I talked to in the Latin America and the Caribbean area. And number one would be financial digitalization and inclusion. And when I say digitalization, I mean the central bank is trying to basically push the financial sector into offering more digital products and so on. And that's important for countries where maybe the commercial banks are lagging a bit in that aspect. And that goes hand in hand with enhancing inclusion, inclusion is particularly important for countries that have very dispersed populations that may not have access to bricks and mortar banks and automatic teller machines and just are excluded from banking for some reason or another. So that's the digitalization and inclusion are two big ones for this area. And the other is reducing the cost of managing and the risks of managing physical cash and creating a more resilient form of currency. And resilience is a big issue, for instance, the Caribbean, where you have the high risks of hurricanes and natural disasters that mean that the currency has to be able to withstand downtime, power downtime, and internet access downtime. And physical cash costs, I think that's rather important because for smaller countries, the fixed costs of issuing physical cash are quite high, and also the costs of transporting the money can be quite high and the risks because it's being dispersed over big areas. So those I find the two primary ones that I hear from the Americas. Another one that's popped up is accessing granular real-time payment data. So a few central banks have told me that that's an important motivation for them because they can tap into real-time payments and feed it into their macroeconomic and monetary policy models. The last one, the improving cross-border payment efficiency, that means remittances. That's another important one, particularly in the Caribbean, where I think the Caribbean is very interested in forming sort of a zone in the Caribbean where all the countries can basically work on an interoperable platform. And the commercial banks aren't stepping up to do that. So the central banks are very seriously considering that. There's all the other motivations are ones you hear more from the advanced economies, like in case of Sweden and Canada, they're particularly concerned about declining cash usage, and that means the people aren't using central bank money, which can be quite an important problem for monetary policy implementation. In the US, among other countries, they've thought about introducing CBDC to distribute stimulus payments, basically government to person G2P payments is a possible motivation there. In some of the advanced economies where their policy rates are zero or negative, the CBDC can be remunerated. In other words, it can have an interest rate on it that can be used to make the cost of carrying cash more expensive. Catch with that though, and so nobody's really talking very seriously about that, is that in order to break the zero lower bound with a CBDC, you'd have to also open up the possibility of eliminating the use of cash altogether. And that's not something that any central bank that I know of is considering. None of them they go to their way to say, don't worry, we're keeping physical cash, because many people prefer that. We always stereotype the old people, for instance, they prefer their cash. Also, it's important to maybe have cash around as the ultimate backup, because I talked about resiliency before. The ultimate resilient currency is cash. You could have all the power down, internet down, and you still use cash. So I think the idea of eliminating the use of cash is kind of a pipe dream. I think at the very least, a central bank would have, if they were successful in reducing cash usage to zero, would be well advised to keep a stash of it on hand in case they need it for that. And the last one and that's particularly important to some of the reserve currencies, as they're looking to use CBDC to basically jump in front of the global stable coins like DM, which was called Libra before. And so that's not, I'm not hearing that as a very relevant rationale amongst the Latin American countries. And then there's the risks of issuing CBDC. That the big one that everyone talks about is the risk of bank intermediation, and that happens if you make this central bank digital currency so attractive that everybody wants into it, and they take money out of their bank accounts and put it into CBDC. That's particularly important if that CBDC is bearing interest and the interest rate's too attractive. But it's not. I mean, there's ways to design around that. We'll talk about design in the next slide. But that most people look at this topic seriously. They've come up with various ways you can design away the risk of bank disintermediation, and that goes also hand in hand with the risk of bank-run risks, because the CBDC would offer an easy way of just punching a button and transferring money from a bank account to a CBDC. But again, that can be mitigated with the same kind of design issues that we talk about next. It could also affect transmission of monetary policy. Put it in gray because, again, when economists look at this topic seriously, they find that actually, if anything, it's likely to enhance the transmission of monetary policy, because it's put in more, if it's successful in including in the financial inclusion motivation, then they've got more people who are actually using central bank money. So that tends to be like an accelerator on monetary policy rather than something that dampens it. And the last risk would be, and this is really a risk actually that's more aimed at the reserve countries, that if they issue a CBDC that's available across borders, they could increase dollarization or currency substitution, which might be a relevant issue for many Latin American countries who are often already quite dollarized. But this is kind of a risk that you can't handle from a Latin American perspective, but it's something that at the top levels, at the G20 level and so on, this is a very hot topic right now to make sure that as we digitalize currencies, we don't create dangers and for the smaller countries that are not reserve countries. Then, in terms of design considerations, first of all, you have to decide who can hold them. Generally, with the CBDC, that's going to be the general public, anybody. Then there's also, you might want to have limits on holding and transaction size, and that's kind of a key to mitigating that run risk and the disintermediation risk. That's a very important tool for managing that. So if you say that you can only transfer X amount of money to CBDC in one day, and you can only hold so much, that's an easy way of controlling that disintermediation risk. Then the other key issue is whether to make it offline, and there's various different design features that can be introduced to make it available when the power's out and the internet's out. And then there's convertibility limits, and that kind of pertains actually to the modes by which you buy CBDC. There's as a Bank of England economist who proposes that you can only essentially trade cash, physical cash, for CBDC. And that's the ultimate way of controlling for disintermediation, because you would not be able to in that world transfer from a bank account to a CBDC. An important design issues revolve around privacy and transparency, and there's a kind of a tension here between users who like the anonymity and privacy of cash versus the interests of the central banks and other authorities who are trying to control financial integrity risk, i.e. Anti-money laundering risk, tax evasion risk, and so on. So there's quite an art to balancing off those interests. I mentioned interest bearing before, and so that could be something that could be designed into the CBDC, even if the interest rate is not actually used. Most of the central banks that get down to this level of detail are including the option of issuing a CBDC with interest, even though they're not planning to use it immediately. And often we talk about future proofing, and this is an example of future proofing the CBDC. so that it doesn't. So if your policy stance changes, you don't have to redesign the whole thing. And then it's possible to produce central bank digital currency that's programmable. And people have talked about the idea of using programmable CBDC to have point of sale tax payments, integration with Internet of Things and other kind of devices, on automatic distribution of economic relief based on demographic and other characteristics. I don't think anyone's seriously thinking about this because there's a lot of risks. I mean, already CBDC is introducing huge amounts of cyber security risks to the central bank, and then you really increase that risk, I think, if you make it programmable. So most are not seriously considering programmability, at least at this stage. And then there's the decisions of what kind of technology platform to use. Most seem to assume that a CBDC will be based on the same distributed ledger technology that, say, Bitcoin and so on is based on, and that's a good possibility. And many of the experiments, pilots, and so on are using decentralized or distributed platforms. But you can also create a CBDC on a centralized platform, and there's vendors that are offering that too. So the centralized platform would work essentially like what we all use in credit cards and debit cards as a central ledger keeper. And so far, from what I observed, is centralized ledgers seem to be favored by many of the bigger countries with huge populations, because there has been some concerns raised about the scalability of distributed ledger technology platforms, that they can't achieve, they can't handle the sheer size of the population that's going to be using this CBDC, and as a result of that, the speed of the transactions is diminished. And then there's a big question about cross-border functionality and interoperability, and it would be important, for instance, for central banks looking at the options of using it for remittance flows and currency and regional networks of CBDC. So these are some of the very high level, the kind of considerations that central banks are mulling over in their CBDC decisions. This is just, I'm not going to spend, this is actually my last slide, but this is kind of what we observe to be the decision-making process flow. And the International Monetary Fund has kind of embraced this as being kind of the flow that we prefer when we're doing technical assistance to member countries who come to us for central bank digital currency assistance. It also is very consistent with a toolkit that's been put out by the World Economic Forum. It has a similar look and feel, but it basically, we bring this forward to central banks that come to us looking for assistance to. And I think that first slide at the top, clarifying objectives, is the key one, because we find that many of them come to us and say, some vendors come to us and said, "Wow, you've got to jump on this central bank digital currency train because it's where everyone's going." So people jump right into the design choices and technology assessments, and we like to think and say the IMF likes to think of itself as the party pooper here, and to say, "Whoa, wait a minute. Let's first of all consider all the objectives and pain points that you're trying to solve with a CBDC, and look at other options too." And that may not be a central bank digital currency. It might be something like building out a fast payments system, something like that. So that's kind of the key point of this chart. And then the way the flow goes, you can see as you get down to the bottom, at any point in here, you might discover that CBDC is not working out for me. You might go through after a pilot, discover that nobody wants to use it. And so in that case, you postpone or exit the process and look for other potential solutions to the pain points. So that's just an overview of the framework that we preferred. And I think most central banks are following that. And this is just a nice little graphic to show, how important getting all these things right is for the central bank, because the central bank's main asset is its reputation. So you fail on any of these points, like you create a central bank digital currency that you launch and nobody uses it. I mean, that's a huge, that could be hugely damaging to the reputational risk of the central bank. But you can see there's risks, and there's financial and operational risks, and then it's all got to be consistent with the overall policies and strategies of the central bank. And that's the end of my slide. I'll just point to the, if you get your hands on the slide, I've got a list of references at the back of it with clickable. They're all clickable to the, these are what I view as being the kind of the best of the papers that on the practical aspects of CBDC. And I keep this one live on my website too. Thank you.
Thank you, John. Very interesting presentation. Let's move forward to Chi's presentation. The floor is yours, Chi.
Thank you. Good day, everyone. Thank you for the opportunity for me to speak here to share with you some of what I know about CBDC that's developed in China. And throughout the presentation, I'll use ERMB as China's CBDC. Yes, so on the first slide, which is actually the next slide, I'll talk quickly about how China designs its ERMB, the CBDC. And then I'll move on to the groundwork of the digital RMB expansion from a political economy perspective. So at this point, from what we understand, what we know, China has a two-tier system for development or for issuing the ERMB. At the top there is the PBOC, the central bank there, and it will issue ERMB to intermediaries designated by the central bank. And these are basically the major banks, and also payment platforms like WeChat, Alibaba, and so on. So for every one ERMB is issued, it must be backed by one physical RMB. So it's a 1-for-1, and there's no interest paid on the ERMB. For every single ERMB that the intermediary gets, it will have to place exactly the same amount of funds back to the central bank. So it's a 1-for-1 exchange. So the central bank only deals with the intermediaries at the issuance level. And then for the distribution level, if you go further down there, the banks, the intermediaries will issue ERMB to the individuals, to the companies, who are their customers. And for the same practice, when these people, these companies, when they get the ERMB, they have to put back, they have to pay the bank exactly the same amount of physical RMB to exchange for ERMB. So that's distribution. So this way, the PBOC doesn't really need to deal with the retail people. It just leaves it with the banking system or the payment platform. And then beneath under the payment platform, the intermediaries, when the companies, they get ERMB, so they buy, sell things using ERMB as payment. So that's the circulation part. So this is basically the setup here, that the two-tier system that China is using. The central bank doesn't really need to care much about how to distribute, how to manage, retail people demand for ERMB and so on. The ERMB doesn't pay any interest. What's also important to know is that the ERMB is not loanable. So when the ERMB goes to the banks cannot lend them out. They cannot lend in ERMB. So, and the PBOC's initial goal, from what I understand, is to digitize about 10% of M0, of the base money. So that means 10% of M0 in the system there will not be loanable. So that has a direct impact on reducing the money multiplier right away. So we won't go into that in details because of time, and that's not our focus tonight. So that's the design of the ERMB. Now I want to move on to the groundwork that China has been doing in expanding the digital RMB, not really physically sending out the digital RMB yet, but then what it's been doing through other tools, other ways. So the next slide summarizes the way that the China has been doing it recently, especially since COVID-19. So there are two key tools that China is using to built the groundwork for expanding the digital RMB to other regions, other countries. First is the Digital Silk Road, the DSR, which was launched in 2015. And then the second one is the Health Silk Road, the HSR, which was launched 2016. Now, the Digital Silk Road aimed at improving the recipient countries' telecom network, digital technologies, and so on. So that all relate to AI development capabilities, cloud computing, and so on and so forth. Everything that is technological related is on China's Digital Silk Road network development there. It also aims at helping countries or recipient countries to develop smart cities and other digital economic areas. For the Health Silk Road, it has a more focused purpose, and that is to cooperate with principally Asia and also other developing countries along the Belt and Road Initiative routes. Cooperation with these countries on digital economic development, medical aspects, to combat infection disease like COVID-19 through information sharing, medical assistance, transfer of knowledge and whatever from China to the other countries. So if you look at the design of these two big tools, they are basically exporting China's technology to the other countries, basically the developing countries, helping them build their system, their digital system, and so on. But this recent expansion is not really a recent phenomenon. Back in the late 1990s, China had actually started paying to pave the way for developing countries to use Chinese technology. Because through significant investment in technological, in digital investment, technological development in these developing countries. From what I know, as of 2017, the amount of total digital investment that China put in the developing countries, the BRI countries, was more than the total amount of funds that the African governments put together, plus the G7 funds put together, plus the multinational agencies put together for developing technology in the developing countries. So China actually, was ahead of the game in putting a lot of efforts and investment into these developing countries. So that's actually it's an expansion of China's soft power. But from a digital RMB perspective, this is an expansion of the groundwork that can easily leverage by launching eRMB later on into all these other countries. Now, from a more political economy perspective, my next slide argues that the digitalization of the Belt and Road Initiative through the Digital Silk Road, through the Health Silk Road, and also the launching of an eRMB, the CBDC of China. From my understanding, it started off as a defensive strategy to reduce China's exposure to US dollar risk, as many other countries are trying to do. But mind you, I agree that a digital currency is not a silver bullet to solve all the Chinese structural problems. The Chinese still have to work hard and work on structural reform and so on. But the point here is that China sees its bigger risk exposure to US dollar being the US cutting off Chinese financial institutions' access to US dollar clearing. Now, I don't think the US will do that because it will hurt the US and the world as much as it hurt China, or maybe even more. But I think from Beijing's perspective, it just doesn't want to take that chance. And that's why it's thinking about a way to sort of defend itself, protect itself. And the eRMB is born out of one of the key political economic reasons for China to develop that is to reduce Chinese exposure to the eRMB. Now, but then following from this defensive strategy to develop the eRMB comes the offensive part of digitalization of the Chinese system and also the currency. Because China has been initiating many international cooperation on researching, setting up central bank digital currency projects. The most recent one I remember, I know of, was last December, the launching of the MCBDC bridge project, the multiple CBDC bridge project, initiated by the PBOC, and worked together with the Bank of Thailand, the UAE Central Bank, and the Hong Kong MA. And then plus the digital Silk Road, the health Silk Road. So these are basically, all this expansion of network of Chinese technology into the recipient countries. And then there's one other more prevalent factor that will make the launching of eRMB easy when China thinks it's ready, and that's the global reach of the Chinese tourists. That many countries they have systems to accept Alipay, WeChat Pay, to cater for Chinese tourist payment. So when you look at all these Chinese technology supporting the digital payment means have been made prevalent in many countries already. So that when COVID-19 is over, when the Chinese tourists come out again, when commerce comes back, when trade comes back, they can easily be revived. So that's the sort of the way that I see China expanding softly the digital RMB network, not right now expanding, launching the RMB yet, but then the groundwork is all there. So if we fast forward and look at the longer term picture, which my last slide shows, I have this title for it: divided we may stand, because a few angles to it. Now, since COVID-19, many developing countries, especially those along the BRI routes, they are more willing to accept and use China's renminbi and Chinese technology. So these countries could eventually develop into a critical mass in different regions, using Chinese technology, using Chinese digital currency. But then on the other side, there's the developed world, led by the US basically, that is still sticking with the US dollar and so on, or the euro and so on. So it is conceivable that in the long term, I don't know, it could be 25 years, 30 years down the road, when the Chinese launch the eRMB in a big scale, we could see that there's a tripolar world emerge with a US dollar zone, a euro zone, something like that, and then a digitized RMB zone with the countries that accept and use Chinese technology and Chinese eRMB. Now, following from that is a technology angle that in such a new world, this tripolar world with three key currencies there. In such a new world, it may also lead to what a lot of the tech experts have been talking about: bifurcation of the internet into one system led by the Chinese, the other one led by the US. So I think these are very long-term things that I think might happen. I'm not saying that they will happen, but that it might happen, because given the direction of the development and how assertive China has been pushing various tools to sort of lay groundwork for the eRMB development, this could be potential outcomes that the world will be facing some years down the road. So I'm going to stop here for discussion and Q&A from the audience. Thank you.
Thank you, Chi. Very interesting, your presentation. We had a couple of questions prepared to discuss among us, but I've been receiving some questions from the audience. So first of all, I encourage everyone that is assisting to the event, please, you can send your questions through the chat or the Q&A from Zoom. There's a couple of questions related. There's Silvia Mera from Colombia and Christopher Alaña from Venezuela that discuss a little bit of what could be the impact of a global impact, right, on implementation of these CBDCs in terms of the monetary policy of local central banks. So let's talk about digital dollarization or some other effects. So it would be interesting to have a little bit of discussion on that point. I don't know if Chi or John, whoever wants to jump in and answer, please do so.
Well, since I opened up the topic in my slide, I'll take a first crack at it. I think that there's actually two things that are of concern here. One of them is that a major reserve currency, U.S. dollar or the euro, they offer up a CBDC that is seamlessly available in all countries of the world. I mean, that very well could accelerate dollarization or euroization, which obviously will stunt the ability of local central banks to conduct independent monetary policy. I mean, it's already hard enough, I think, for those that are dollarized, but this will just accelerate that process, which is why I think the G20, working with the Financial Stability Board and this Committee for Payments Markets, Market Infrastructure, CPMI, they've got a major project underway that's addressing this very issue to ensure that those reserve currency countries, their central banks behave responsibly with respect to that risk. But the other part of the story is that everyone's kind of braced for this new Facebook sponsored currency. It was called Libra originally. Now it's called Diem. And initially the idea was they were going to launch a digital currency that looks an awful lot like the IMF SDR. It would be based on a basket of currencies, and it would be available through all the traditional Facebook apps like Messenger, Instagram, WhatsApp, and so on. And then that would be another avenue for that kind of either dollarization or something, a domination of some foreign currency in all the local economies around the world. They've since downsized their aspirations, at least initially, to offer instead of a basket, they'll offer individual currencies, but that probably doesn't mitigate that same risk. So instead of having a basket DM, now you have a US dollar DM, you have a euro DM, so that and all available on everyone's smartphones, and that's the reason, in fact, why many central banks are looking at offering CBDC to push back on that, to the extent that that offering a digital version of the local currency will mean people will want to use that local currency more. I mean, I have questions as to whether that's really going to happen. I mean, why isn't the economy dollarized? It's not usually because the local currency is awkward to use or anything, and that the dollar is easier to use. It's often based on trade patterns and so on, or reserve needs, and so I'm a bit skeptical about that as a rationale to offer CBDC for a smaller market country, but it is something they're looking at. So the CBDC could play two roles. On if a CBDC offered by a reserve country, it could be very dangerous for the smaller markets. On the other hand, the smaller market countries can use CBDC to push back on that kind of either CBDC dollarization or currency substitution that's being pushed by the likes of Facebook. Chi, do you have anything to say?
Yeah, I have a different angle looking at the impact or the operations of the CBDC, and that it's on the payments and the banking system that I'm referring to. Now, in John's presentation, he alluded to already, the central bank's incentive to launch CBDC, which basically is also relate to the benefits of having digital central bank currencies there, and which is to basically reduce costs and efficiency of payment systems and the banking system there by using digital distributed ledger technology, DLT, such as blockchain. Now, if you push that thought further, a CBDC system for international payments would help to standardize operational and settlement system. across different institutions, across different countries, across different time zones. And assuming countries can sort out their regulatory issues and differences, that would create a single global network with a uniform kind of everybody generally accepted regulatory framework for settlement to allow cross-border payments to be done instantly around the clock. So these are the big benefits. But when I think about it from a banking system perspective, these benefits could easily kill the current corresponding bank model that is dominating our international transaction settlement, because such a model is expensive. I suffered from it as well, because when I remit money, I've got fees charged. So if CBDC is really being implemented in the international payment system, I think the corresponding bank model could be gone quite easily. So with China now and a couple of other smaller countries getting ahead of the pack in developing CBDCs and experimenting them, I think these countries that are now ahead of the pack would be putting pressure on other countries, other central banks, and the banking system to seriously think about moving towards CBDC.
Thank you, Chi and John, for your views. There's other couple of questions that are related. One from Joaquín Bernal from Banco de la República of Colombia, and Julio Tambini from the Central Bank of Peru. Both kind of go towards the same topic: is what alternatives to central bank digital currencies are out there? Some countries already have fast payment solutions, which kind of in some of these areas are you have a similar goal or objective than a CBDC. I guess depends on the motivation, right? That you're doing the research on CBDC. But what other alternatives do you think there are out there, and what does CBDC actually have as an advantage of these alternatives?
Well, how about if I jump in there? I promised at the start of my presentation, I mentioned synthetic CBDC, and I said I wouldn't talk about that, but I think that this question brings that up. And first of all, let's start with the definition of a stable coin. The stable coin is a crypto asset, very much like Bitcoin and so on. And it trades on transfers on a distributed ledger technology platform. But instead of floating around like Bitcoin, everyone knows how volatile Bitcoin and other crypto assets are with respect to major currencies. They're crypto stable coins or crypto assets that are pegged to a major currency, and most all of them right now are pegged to the US dollar. And the way they achieve that peg is that for every dollar of the stable coin that's offered, it's backed by $1 of assets, US dollar assets, possibly US treasury bills or treasury notes, or it could be deposits at US dollar deposits at the commercial banks. That's the typical stablecoin model, and one that dominates the stablecoin world out there. Now, what a synthetic central bank digital currency does is it takes that model and says, okay, these private sector issuers can continue to offer these stablecoins, but instead of placing their backing reserves into banks and government securities, they place them with the central bank. So you're basically opening up the possibility of non-banks of non-bank stablecoin issuers to place their funds at the central bank, and that's in essence what a synthetic CBDC is. So it's synthetic in the fact that it's kind of backed by central bank reserves, but it's offered by a private sector player. And arguably, some synthetic CBDC already kind of exists in one form or another. Alipay and WeChat Pay, for instance, their funds that back those payment systems are now obliged to be held at the People's Bank of China. So it's kind of like a synthetic CBDC. so that in fact, that's a model that the IMF has been pushing quite hard. And the advantage of we didn't get into this in the design speaking, but when you think of a CBDC, you might think initially, oh, that means that the residents and holders have direct accounts at the central bank. But as Chi showed in the case of the digital yuan, that's not the case. That you're actually interfacing with the private sector payment system providers, and so the synthetic CBDC concept takes that one step further, and so it sort of cuts that direct relationship between the intermediary and the central bank, and in a way that it's probably a better model. I mean, the model where the central bank runs everything. They issue the central bank digital currency, and they manage the ledger. They also supply wallets to customers, and they do all they basically run everything from step one to the last step. That's no central banks that are experimenting or thinking about CBDC are contemplating that. They basically want to form public-private partnerships to let the private sector look after the things they do best, interfacing with customers and so on. So the synthetic CBDC is just one more step in that direction. So I think that's a viable model to consider.
Well, from what you said just now, John, that it seems that the Chinese setup so far is mixing a lot of the CBDC and the synthetic, because you mentioned WeChat Pay and Alipay. Now, the Chinese don't see them as sort of synthetic CBDC. The Chinese government see them as payment platforms, and then the ERMB, the yuan, is the currency. It's actually part of M0, but it's digitized. So a related question I got asked often is that, is the PBOC thinking about replacing Alipay and WeChat Pay when the ERMB becomes prevalent? So far, from my understanding, the PBOC hasn't thought about that. It has no intention, because the PBOC, as I show in the first slide, that the PBOC only wants to deal with the intermediaries that it designated. It doesn't really want to get into the retail business or the headache of managing tons and tons of data or whatever. But these guys, they all have Alibaba and Tencent. They have so much data through the big data pool there that they have even more data than the government has. They have even more data than the banks have. So the Chinese are actually very, very efficient in this way, that they leave the payment circulation, the payment platform alone, let them keep functioning, but then going into the circulation part of the kind of the currency used instead of paper RMB, that will be a part of it in digital form. So I don't know whether the Chinese are thinking about synthetic CBDC or they are just thinking very simply to coexist at this stage of development, to have the Chinese CBDC coexist with the electronic payment platforms that Tencent and Alibaba have set up for 20, 25 years already.
I think what she says kind of speaks to another problem for the CBDC technicians like me. We wrestle with every day. It's how you describe a CBDC, because each country's model is different, and someone like you could think that the digital yuan is kind of a synthetic the Alipay or WeChat Pay synthetic CBDC, but maybe even the digital yuan itself is effectively not really a pure CBDC, but a synthetic, and so you run into these taxonomy. In fact, I'm on a working group that's sponsored by the UN agency called the International Telecommunications Union that's wrestling with this, and there's fierce debates that rage around this sort of fundamental question of how you describe these different digital currencies.
Yeah, actually that's right, and the evolution, the dynamic of the topic it has been very interesting in the last few years, and I wanted to ask Chi a specific question related to China's experience, and what do you think are you mentioned something in the last question, a couple of things that could be useful for or a special interest for Latin American countries to learn about the Chinese experience on CBDC. So what would you think that are elements that Latin America could focus on that are good lessons learned or about the Chinese experience?
I guess if Latin American countries or any countries are considering seriously issuing CBDC, and if they want to learn something from the Chinese, is one. This basically applied to the developing countries. Basically, that's one thing that I think they can learn from China, or get something out of the Chinese experience, and that is that the Chinese have leapfrogged many other countries, including the US, in terms of the financial development, that they have done away, or they haven't really gone into the credit card type of business. They jumped from banking, cash, right into peer-to-peer payment, e-payment, using Alipay, WeChat Pay. Credit card in China is just not common. When I go on business trip, I use a credit card. I remember some years ago they were still asking me, is this a foreign card or local card? They have different systems in settling. So, and then in the end, they just don't care about much the credit card. I think that's an advantage that China has, and this model or this experience that other countries can learn from is that without the big credit card business, which links to the banks' lobbying power, you just don't have that big lobby group trying to protect their existing business and leave the room for the development of paperless electronic payment systems, which directly relate to the digital currency form of the country's currency. So I think that's something other countries can sort of learn from China because of the Chinese experience of doing away with the middle part between banking and digital payment. There's no credit card kind of business.
Thank you, Chi. Well, we are almost out of time, but I will ask a last question to John. It's very difficult. I will ask you to answer it in 1 minute if you can. It's a very difficult topic. Digital identity is a huge topic of conversation in the last few years, and it's an important enabler for CBDCs. And specifically, Latin America is still a long way behind in terms of digital identity. So, in absence of this infrastructure, what would you say it's the best approach for digital onboarding?
Well, I like to ground what I say in reality. I've examined how 3 of the major pilots have run the ID challenge, the Central Bank of the Bahamas and the ECCP and the Uruguay. Then they don't have universal digital identification systems either. So when you sign on to the app by which you trade this CBDC, they use various other different modes. So most people, these are all designed to be used on smartphones. So you typically have to have a SIM card, right? So for instance, the peso that Uruguay piloted was basing their ID on a SIM card, and you have to put in your physical email address. And also some other platforms will require you take a scan of your passport or some other kind of ID, driver's license or whatever, or just provide just various details, phone numbers, and so on. So I think you can meet that challenge by sort of cobbling together different solutions. I don't see the lack of a universal digital ID as being a deal breaker for CBDC, although I think it's not a bad idea for every country to be thinking along those lines.
Thank you, John. Unfortunately, we ran out of time. It's 1 hour. We could be discussing this for days, probably. Each of these topics are. We could do a deep dive, very very long. So thank you to Chi, thank you, John, both, and Antonio. The floor is yours. Thank you for the invitation.
Many thanks for your insights today. Once again, on behalf of FLAR, I would like to extend our deepest gratitude to our guests, Miguel, Chi, and John, and their institutions, the Central Bank of Chile and BAP Asset Management, especially to Paul Younes, who make this collaboration possible. We learned a lot from you today, and this will definitely be a revolution in money as we know it. To our audience, we will be back in June with another relevant topic for central banks community in the region. Until then, stay safe.
Thanks, Antonio.
Thank you,
It's been a
Antonio.
great pleasure.
Thank you very much.
Pleasure. Bye, John. Bye, Chi.
Bye.
Bye-bye. Bye.